This week's topic is capital allocation to risky assets. What constitutes a satisfactory investment portfolio? Until the early 1970s, a reasonable answer would have been a federally insured bank savings account, which is a risk-free asset, plus a risky portfolio of US stocks. Nowadays, investors have access to a vast array of assets and can easily construct portfolios that include foreign stocks and bonds, real estate, precious metals, and collectibles. Even more complex strategies may include futures, options, and other derivatives to ensure portfolios against specified risks. Clearly, every individual security must be judged on its contributions to both the expected return and the risk of the entire portfolio. Last week, we began with an examination of various conventions for measuring and reporting the rates of returns for various assets. Next, we turn to the historical performance of several broadly diversified investment portfolios. In doing so, we use a risk-free portfolio of treasury bills as a benchmark to evaluate the historical performance of diversified stock and bond portfolios. In this week's class, we would consider the trade-offs that arise when investors practice the simplest form of risk control, which is capital allocation. Capital allocation is the act of choosing the fraction of the portfolio invested in virtually risk-free securities versus risky securities. We show how to calculate the performance one may expect from various allocations between a risk-free asset and a risky portfolio, and contemplate the mix that would best suit different investors. With this background, we can evaluate a passive strategy that will serve as a benchmark for various active strategies which we would come across in later chapters. This chapter's material can be roughly divided into three main parts. First, we'll begin by discussing the concepts of risk aversion and investor utility. We would then develop an understanding of the allocation of funds between risky and risk-free securities. This comprises of a two-step process of portfolio construction. In the first step, we find the composition of a risky portfolio, and the second step comprises of the capital allocation between the risky portfolio and the risk-free securities. Finally, the concepts of risk aversion and capital allocation will be brought together to show how investors decide on what proportion to invest in safe versus risky assets. We'll also be introducing the capital allocation line, which is a plot of the risk-return combinations available by varying the portfolio allocation between risk-free assets and a risky portfolio. Finally, we'll conclude with a discussion of passive strategies and the capital market line. The capital market line is essentially the capital allocation line using the market index portfolio as the risky asset.